Hi, Nishi here, and you are watching part 3 on our mini-series on how small businesses can use holding companies to save tax. This part is all about how to actually set up a holding company, but the other 2 parts we did is about the advantages of a holding company and the tax savings and disadvantages of a holding company. So it's worth checking those out as well. I'm not going to go into loads and loads of detail in this section because actually we make our money by setting up holding companies. But what I'd say is, because you're probably dealing with tens of thousands of pounds and a pretty severe tax consequence if it goes wrong, take us up on our offer. It's £420 for a complete limited company, holding company setup, including the tax plan. So it's actually very inexpensive to get a proper accountant to do it for you, but I'm going to give you a bit of an overview on what we do in this video, just not all of the tiny little details that we have to get. So let's get into it. If you want to set up a holding company, you might just Google set up a holding company and you'll get a load of ads there, and it'll be like holding company set up for like £10, £12. It might be one of the banks doing it. It might be one of the formation agents doing it. Do not click on those ads, and they will not set you up a holding company. They will incorporate for you a company, but unless all the correct paperwork behind the scenes has been done and the dates are correct and the structure is right and the valuations are correct, it's not a holding company. It's just a limited company you've got that you've called a holding company. So let's talk about what is actually involved in setting up a proper holding company. So at the very beginning, the chances are you have a trading business that's making money and you're probably selling services or selling widgets, and you're buying stock and you've got expenses and you're left over with a profit after that in your trading company. So you own your shares in your trading company directly yourself. By the way, you might just be setting up a holding company from scratch. You still got to get that, but it's a lot easier in that case. But let's say you've got a business that you're trading through at the moment and you don't have a holding company, you just own those shares directly. Then what you have to do is you have to insert a holding company between your trading business and yourself, so that the holding company owns your trading business and then you own the holding company. What this methodology is called a share for share exchange. What's actually happening here is you are giving this new holding company you've created all of your shares in your trading company in exchange for the holding company giving you shares in itself. And that's a share for share exchange. And the idea behind that is, once you've done all that, your holding company will own your trading company and you will own your holding company. So it sounds simple, but there's a couple of challenges that you're going to have here. Firstly, you are essentially disposing of your shares to another entity. So you're disposing of your shares in your trading company to your holding company. That is a disposable for capital gains purposes. The second challenge you've got is your holding company is acquiring shares from you for that trading company, which is a acquisition for stamp duty. So, although stamp duty on shares is only 0.5%, is still something to consider. So those are the challenges which you may end up getting stung by, the capital gains and the stamp duty, if you don't do this right. So what happens is there are actually also reliefs available, because let's face it, a lot of businesses do need to set up a holding company or insert a holding company for valid reasons. Like, for example, the protection of assets is a very valid reason. Having flexibility in terms of distributing dividends to various business partners is a valid reason. Being able to reinvest post-corporation tax profits without having to incur dividend taxes is a valid commercial reason for actually having a holding company. So the government has 2 main reliefs available to people who want to set up a holding company. There is the relief from capital gains tax under Section 135 of the Taxation of Capital Gains Act. And there is also the relief for stamp duty as under acquisitions relief under Section 77 of the Finance Act. So those two reliefs. But the main thing is you've got to do this in the right way, get the dates right. You've got to get the paperwork right to make sure that these reliefs are valid. The good news about the relief from capital gains tax is it's automatic. You don't have to apply for it. What you can do is just say, look, write down your reasons and expect that relief to be available to you. What you may want to do, though, depending on the level of risk and the valuation of your businesses, you may want to get something called advanced clearance from HMRC, where you go to HMRC and or your accountant does on your behalf and then explains all the reasons you want to do all this restructuring and get HMRC to acknowledge that it is for valid commercial reasons and they're not going to object to it later, and then expect the capital gains they'll offer you. The other side of it to it, though, is the relief on stamp duty, unfortunately, is not automatic. You have to apply for that when you send the stock transfer form to HMRC for stamping. The challenge with that is usually HMRC expect a formal clearance application, and the formal clearance application for that relief on stamp duty often costs more than the actual stamp duty itself. So quite often when we are setting up holding companies for clients, we will look at the level of risk involved in terms of HMRC challenging it on the grounds of capital gains. If that risk is minimal and the commercial reasoning is clear and we're confident we'll always be able to defend that, then we may recommend to the client not spending $3-4 grand on that professional clearance, on that clearance request to HMRC, and just to take the risk because the risk is low. But at that point, they may also then have to forego the relief from stamp duty and then just pay the stamp duty on the transfer. You might be thinking, a share for share exchange, it's I'm not selling anything for any money, I'm not getting anything for any money, so why would there be stamp duty? Your business has a valuation, and when you're transferring that business to your holding company in exchange for shares in that holding company, the shares in the holding company are worth something, because the minute your shares in the trading company enter the holding company has value, and then you are then receiving something of value in exchange for relinquishing your shares in your trading company. So that is consideration, and stamp duty is due on that based on the valuation of your business. But as I said earlier, quite often it's just easier to pay the stamp duty than get that clearance. Spend a lot of time talking about clearances, all that kind of stuff. But the main thing is that's something you need an accountant to really work out for you in terms of the level of risk. So once you're going down the share for share exchange route, you've got a valuation of it for your business, because on the stock transfer form, you do have to put a value for your business on there. And then you can then fill that stock transfer form in. You can then file a confirmation statement to update company's house on new shareholdings. And you are then in a place where you've essentially set your holding company up. So that's the gist of it. Right? Being able to deal with that holding company on the balance sheet in your accounts is slightly more complex. You do need an accountant that understands this stuff. Your average accountant probably doesn't, which is the reason you're watching this video in the first place, because they can explain this to you themselves. But overall, if I could just summarize that, realistically, you're valuing your business, deciding whether to do a formal clearance request. By the way, the downside of doing a clearance request is if HMRC reject that clearance request, you may have to actually go to a tribunal to have it overturned. So that can add a lot more risk and delays as well. They take about 6 weeks to get back to you on a good day. So those are downsides of the formal clearance request. Then you're doing your stock transfer forms, and then you're updating things on your confirmation statements. That might sound easy, but as I said, for £420, we'll set the whole thing up for you. We'll do the planning. And the only caveat to that is you need to become a client, use us for your ongoing accounting services, and you get all of that, plus the ongoing tax planning, which you will need for your holding companies. This is the gist of it. And what I invite you to do is get in touch with any questions you've got. If you think you want an accountant to set all that up for you, then definitely get in touch, because we will do it quickly, efficiently, and look after you in the long term. So thanks for watching this 3-part series. As I said, if you're watching on YouTube, we do have the full article on our website with everything structured, everything laid out. So just go to articles at n-accounting.co.uk and you'll see all of that. And I will see you at the next video or in person, hopefully, if you get in touch.